Good morning, Monday, June 23rd, 2025. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer of Cantor Fitzgerald Managed ETF Portfolios. This is my weekly market and economic commentary. If I have something to say intra-week, it will be on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. This presentation has been prepared by me. It is designed for use by investors, also by their financial advisors. Regardless, everyone is expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment or tax advice. There are no recommendations for the purchase or sale of any securities. Everything is strictly for informational purposes. Any views expressed are mine and mine alone. They may differ substantially from CFIA's parent, affiliates, or other portfolio managers at the firm. Well, mixed week. Small and mid-cap stocks domestically were up, large cap marginally lower, developed international significantly down about 1.5%, bringing the world's equity benchmark down about 40 basis points. Rates came down a little bit as bonds were a bit higher. The aggregate bond index up 0.25%. High yield significantly outperformed. Wow. Floating rate debt was strong. 20-plus year Treasury index strong as well. I would say most of the economic data from last week indicated a softening of the strength in the economy and continues to build the case and the momentum for the Federal Reserve to ultimately cut rates either at the end of July meeting or in September. Let's get into what that data was and why I think that's the case. Here's New York State manufacturing. We know one of the focuses of the administration is to bring back manufacturing capacity, to expand manufacturing domestically, and that number for the New York region dropped to a pretty substantially negative number, minus 16. The estimate was for minus 6. New orders got significantly negative. Shipments went significantly negative. Employment improved, and the outlook improved. So I would say that's poor to mixed. I wouldn't say it's the end of world, and it's certainly not a good report. Similarly, right next door, the Philly Fed survey also went down minus 4, worse than the estimate. New orders fell but remained positive. Shipments went positive. Employment here, though, reversed what we saw in New York and actually declined, and so did the outlook. Putting the two together, I'd say the manufacturing outlook significantly softened for the month of June, which isn't, of course, over. Retail sales for the month of May down 0.9%. That was worse than expected. Still up 3.3 on a year-over-year basis. Back out autos and gas, they still fell 0.1%. Import and export prices. Import prices unchanged. That's better than expected, I guess, or worse than expected. We want them to go down. Up 2.2% year over year. Export price index fell 0.9% and is up 1.7% on a year over year basis. Industrial production and capacity utilization ties back into manufacturing, that's for sure. For the month of May, down 0.2%. Estimate was for flat. Production rose 0.1%. Capacity utilization, though, fell from 77.7 to 77.4. And while we're using less of our manufacturing capacity, the thing is, when you get in this 80 range, you're talking about inflationary pressure. When you start getting down to the 75 range, you're talking about disinflation or deflation. So that's probably a positive for those watching the inflation number, hoping to see the Fed cut sooner rather than later. That gives them a little more air cover, a little more credibility. Business inventories were unchanged for the month of April. Really nothing to see here. The area of the economy that's probably doing the worst is home manufacturing, home construction, and all the different ancillary industries, from agents and brokers to title insurance to escrow officers to repairers to inspectors to everybody that touches that industry. And it's a very, very big part of the economy, and it's just not doing well. Let's start with the National Association of Home Builders. These are the people that build homes. Could be big companies and small companies. This is how they feel, the sentiment about their business. It is a soft data number, and 50, above 50 means they're generally optimistic. Below 50 means they're generally pessimistic. We dropped all the way down to 30. This flirts with the 30 low from April of 2020, COVID bottom. I mean, we're right there. And the December 22 low of 31. It's just an absolute horrible time to be a home builder. There's a lot of systemic issues, plus there, of course, is the rate issue, there's the affordability issue. Present sales, what they view is likely to happen, did not do much better, still coming in at 35. Future sales down to 40. Traffic almost, I would say, non-existent at 21. We move on to housing starts. And so what are the home builders doing? Not feeling good about what's happening. So the starts go down again, down 9.8%. The estimate was for only 0.8%. So that's pretty darn significant. Building permits fell another 2% after falling 4% in April. So that doesn't give us any indication that things are going to get better through the summer. You know, it takes about a year to build a house, but for quite some time. A little bit of relief on initial jobless claims, but you can't go up every darn week. We look at the 4-week moving average and it's troubling. And weekly initial claims fell from 250 to 245. Okay. Continuing claims fell a little, 1.95 to 1.945. Big deal. But what's troubling in all of this is the 4-week moving average just trending higher and higher. Believe me, the Federal Reserve sees this, the administration sees this, they all know about it. This is the argument for cutting interest rates. 245 is not a high number. 300 is not even a high number. Anything below 3 is considered a pretty good labor market. But directionality does matter. They are looking at this, and it just so happens there was an FOMC, U.S. Federal Reserve Federal Open Market Committee meeting last week. The 3 interest rates that they essentially control: Fed funds target rate unchanged, 4.5. Fed funds discount rate, or federal discount rate for banks to borrow from the Fed, 4.5. And the interest the Fed pays on reserve balances at 4.4. The statement from the Federal Reserve following the meeting did have some significant changes, and the statements from several of the governors have had some significant changes that now put July in play. First of all, in the statement, they changed unemployment rate has stabilized to unemployment rate remains low. So they admit that it's low, but they don't feel like it's necessarily going to stay low. They changed the economic outlook has increased further to the economic outlook has diminished but remains elevated. In other words, things are still okay, but they're not getting better, and that's an important distinction. They changed the words, the committee judges risks of higher unemployment and inflation to have risen, which is what they said last month. They crossed that out and wrote, the committee is attentive to the risks of both sides of the mandate. While the voting was unanimous, that came out, of course, on Wednesday. By Friday, the first of the members in a CNBC interview, Christopher Waller, said policymakers should not wait for the labor market to weaken before cutting rates. In other words, he was telegraphing that he is willing to vote yes on rate cuts at the July 30 meeting. Then this morning, another voting member, Michelle Baumann, these are both Trump appointees, by the way, was giving a speech in Prague, and she said it's time to consider adjusting rates. I would support lowering the policy rate as soon as our next meeting. So when we look at this and we see that we're at 22.7% likely in the Fed funds futures market, and I can circle that for you. Whoop, there it is. 22.7% likely in the Fed funds futures market. But now 2 voting members have said publicly they favor this, and we still have about 40 days before that meeting. I think it is likely that you get more governors talking about it over the next few weeks, and you will see these odds of a rate cut increase going into July. Now, they could back off of that as they get CPI, PPI, and core PCE data. The core PCE is the one that matters the most. And if for some reason the weekly claims for unemployment drop all the way back down to 20, they would back off it. But this is the team and the messaging and getting ready to give us a cut for sure now, in my view, by September 17th, Constitution Day. But very live and very real possibility that it could happen on July 30th. You heard it here first. We can't ignore the other massive news over the weekend, which was the U.S. attacking Iran's nuclear facilities with high-tech bunker-busting bombs that only the U.S. has, and only the U.S. has the ability and the technology and the airplanes to deliver. The thought on Saturday night when this happened was that on Sunday, when equity futures opened, they would plummet significantly and that the price of oil would skyrocket. Well, here is a chart of U.S. oil futures. Obviously, this is where we are right here now. The stock market is actually higher today as I'm recording this, and oil is actually slightly lower. What this tells me is that the U.S. has demonstrated an immense amount of strength and willingness to use it. I think the world has always known that the U.S. possessed massive military and economic might, but the world has consistently and regularly doubted the U.S. resolve to take control, to fix problems, to address them. And the U.S. has a history of seeking instead diplomacy, maybe not always working. This now sends a very clear message. And in my opinion, that's why the equities are up and the oil futures are down. Let's move on to economic data that we are going to be seeing this week. We got the two PMIs today for June. These are the flash readings, manufacturing and services, both expected to be positive. Home sales for existing homes under 4 million. We've got house prices on Tuesday from Case-Shiller and FHFA. Consumer confidence, new home sales, jobless claims expected about the same. First quarter GDP, that's a revision number. We know why it was negative. We've been through that before. Durable goods, home sales, personal income spending, the big one, core PCE price index. If this number shoots higher, that delays the rate cuts. If that number is at 0.1 or below, I think it continues to put July live for a potential rate cut. And then finally, consumer sentiment for the month of June. Okay, you can listen anywhere and everywhere at any time. Simply tell your smart device to play Herb Morgan's podcast or play the Slaying Bulls and Bears podcast. My goal here is to make the complex and complicated simple and sensical. Don't forget, the best place to watch is YouTube, because you get my little green pen and you get the charts and graphs that matter to make all of this relevant for everybody. Thank you so much for tuning in. I just found out we are now we are ranked in the top 10% of all financial podcasts or YouTube podcasts or broadcasts in the world. So I really appreciate that. Keep listening, liking, retweeting, passing along to others. It really, really helps. So thank you, and I'll be back in 1 week.